Hey guys, it's Aman
And Christina
from Our Rich Journey. One of the questions we're asked all the time is how are we able to invest in the stock market in order to retire early? You see, Christina and I were able to develop a 7-figure stock portfolio and then use that stock portfolio to retire early, to quit our jobs. And it is so important to understand that we were able to do this because we had an investment plan. We weren't just flying by the seat of our pants, picking investments. We invested decisively and clearly in a certain number of stocks with a certain allocation. And we knew exactly how we were going to build wealth. And it was all because of our investment plan. Now, see, the problem is so many people are investing in the stock market without this type of plan, a plan that meets your ultimate goals. And so on today's video, what we want to do is we want to help you develop this type of investment plan. We are going to give you all of the elements that you need in your plan at a minimum in order to invest in the stock market for financial independence.
So take out your pen and paper because we are going to walk you through how to develop your own investment plan. Now notice those keywords. We're going to walk you through how to develop your own plan. If you've looked up the definition of an investment plan, you're likely going to see that it involves a document and a financial advisor or a portfolio manager that develops that document or that plan for you. We think there are several things wrong with this type of approach to developing a plan. When you use a financial advisor, there are, of course, fees associated with that, but that's not the big thing. The big thing is when you have someone else develop your plan, you're losing control of how you want to invest. A financial advisor may not always have your best interests in mind, and you don't have that ability to understand how the plan is developed if you give over all of that control to someone else. So in this video, we want you to be able to take control of your plan and to develop your own plan that fits your own unique needs.
And developing your own plan is so powerful, especially when you're talking about retiring early and living off of your investments for decades and decades to come. You must learn to empower yourself. And so by not handing off this duty to someone else blindly in most cases, if you do it yourself, you will understand the little idiosyncrasies that need to go into a plan. The other thing is sometimes financial advisors are not looking out for your best interests, and they will put things in your plan that you don't even need and that do not support your overall goal of FIRE. You see, our channel is all about empowering people to do for themselves. And so once you've done this, once you have obtained that knowledge, if you still feel like you want to hand this off to a financial advisor, then by all means do so. But at least you will have the knowledge to be able to recognize if that financial advisor is taking advantage of you.
So let's talk about the 10 elements that should be included in all investment plans. Now remember, your investment plan should be a written document. And the reason for this is because it will help you commit to a disciplined investment approach.
So let's get started with the first element, and it is identify your investment goals. Write this down because no matter what you begin investing in, whether it's the stock market, real estate, or starting a business, whenever you put your money in an investment, you must have an ultimate goal for that money. If it is to retire in less than 10 years with over $2 million in a stock portfolio, then write down that as your goal.
So for this element, you want to be specific. Take out your pen and paper and write down specifically what your goal is. Don't be broad. If you want to retire early, what age do you want to retire by? And how much do you need in your stock portfolio in order to retire by that age? That is what you are writing down in this element of your plan, which is your goal. The next element is to write down your investment objectives. This element is really to help you identify what is the purpose of your portfolio. What do you want it to do? So there are different types of investments that can do different things for your portfolio. For example, maybe your objective is to create a very safe portfolio. You would select investments that provide for safety. Or maybe your objective is to generate a portfolio based off of generating income. That's another type of investment. Or maybe you're really focused on the growth of your portfolio, or a combination of all these things. The idea is that you want to write down what is your objective with your portfolio so that can guide you with selecting the type of investments that can support that type of objective.
The next element you want to write down is your time horizon. How long in the future will you be needing to withdraw from your investments? If your time horizon is short, maybe you are going to be flipping stocks and living off of those profits every single day, then your time horizon is short. Or maybe your time horizon is very long and you are investing now in investments that you don't plan on withdrawing from until 15 or 20 years from now. You're going to give those investments time to grow, and maybe you'll live off of the dividends and the capital gains from those investments. You see, everyone must understand their time horizon as they develop their strategy for buying and selling their investments. Because at the end of the day, your ultimate goal is to live off of your investments. And so at what point will you need to start to do that?
And another thing to keep in mind, it's not just about when you're going to be withdrawing the money, it's also about how long you expect that money to last. So when you're developing your portfolio, your time frame really involves two different aspects: when you're withdrawing that money and how long you expect to live off of that money. The next element is assessing your risk tolerance, understanding how you feel with fluctuations in the market. So if you're the type of person that is constantly looking at the stock market, seeing it go up and go down, and you get anxious about that, you likely have a low risk tolerance. But for us, for example, we consider ourselves to have a higher level of risk tolerance. We are fine with fluctuations in the market. We are even fine with bear markets or crashes in the market. We continue to invest. But understanding your risk tolerance is so important because it will help you identify the investments that are best for you. Now, keep in mind that your risk tolerance has to be tied to the level of return or the reward from your investment. So if you're looking for huge returns, but your level of risk tolerance is very low, then that is not aligned, and you have to find a way to align those two things. As you assume a higher level of risk, you're also able to assume a higher level of reward. But there is a flip side to that as well, because more risk can also lead to the potential of greater losses.
Now, on the other hand, if you are afraid to take on any risk at all, your investments may be too conservative and they may not allow you to meet your ultimate goal of financial independence. The next element is asset allocation. Now, what we mean by this is how are you going to divide your money amongst your various investments? Will you have 80% in stocks and 20% in bonds? Or will you do 50-50? Or will you be 100% here and 0% there? Your asset allocation is so important because it is something that you establish at the beginning of your investment journey. And as your investment starts to grow and move out of your initial asset allocation, you know how to readjust so that you fall in line with your original plan.
The next element are your actual investments and the accounts that you're going to put those investments in. Now, this is you actually sitting down and selecting each of the investments in your portfolio. Are you going to be investing in stocks? If that's the case, what specific stocks will you be investing in? Are you going to be investing in index funds? If that's the case, what specific index fund will you put in your portfolio? And not only your portfolio, but the specific accounts within your portfolio. So if you have a 401k, an IRA, an HSA, a standard brokerage account, you should line all of those accounts up and indicate in each account what specific investment you're putting into them.
The next element you want to have is your rebalancing methodology. You see, once you have your portfolio up and going and your asset allocation is in place, how often would you go back to that portfolio and readjust it so they stay in line with your original asset allocation plan?
So I want to note one thing about the importance of having this rebalancing methodology in place before you begin investing. It will help you stick to a schedule, and it will prevent you from going into your portfolio and tinkering around every time there's market volatility, because that tinkering around can actually be very detrimental to your portfolio. So set up this rebalancing methodology and make sure you stick to it regardless of how the market is behaving.
And this brings us to our next element. Write down how you will respond when the market starts to go through a correction, a crash, or a bear market. You see, how you respond at times like that is so important to the success of your investment portfolio. Will you panic sell at a loss, or will you stay the course and in fact invest even more? You see, it is your response at times of chaos that is really gonna make or break your investment journey.
One thing to note is that it is okay to go into your portfolio and to make changes, but those changes that you make have to be based off of sound reasoning and not some emotional response to something like a crash or volatility in the market. So when you are working on your portfolio, as you're progressing through your investment journey, when you look at this element of your plan and understanding how you may make changes to your portfolio, you can rely on that element of your plan to make those changes versus making changes to your investments based off of emotions. So the next element is to itemize the mistakes that you want to avoid when you're investing in the stock market. Now, these should be very personal to you, maybe mistakes that you've already made or mistakes that you may be more susceptible to in the future. It's almost like a letter to yourself where you're really focused on how to become a successful investor, and by doing this, avoiding certain mistakes that you may make when investing.
So this brings us to our last and final element of your investment plan, and it is your investment philosophy. This is a very special thing to write down, because what you're actually gonna do is you're gonna take into account everything that you did in the preceding sections of your plan. So your time horizon, your goals, your objectives, your risk tolerance, all of that is gonna be wrapped up into one statement that identifies your investment philosophy. Now, the concept of an investment philosophy may sound foreign, or this may be the first time you've really heard it before. But every great investor has a philosophy that guides their beliefs and principles when they invest in the stock market. Warren Buffett is a great example of this. He is a value investor, and his philosophy is focused on investing in companies that provide value. But that's Warren Buffett. You should develop your own investment philosophy that is based off of your beliefs and principles.
So those are the 10 elements for developing your own plan. Like we told you earlier, we have our own plan that we used on our FIRE journey. And if you're actually interested in seeing our exact plan and how we developed it, everything that we invested in on our FIRE journey, we actually make that available in our stock market investing course. So if you're interested in learning more about investing in the stock market, and if you want to see our own plan, and if you want to develop your own plan, you can check out our stock market investing course. We'll leave a link for that course in the description below, or you can go to ourrichjourney.com. But we hope we've given you enough information to really think about how you can craft the plan that works best for you as you're beginning or continuing on with your investment journey. And if you like this video, make sure you give us a thumbs up, subscribe to our channel, and
Join the journey.